Thank you, Margot, and thanks for the chance to spend an hour or a bit more with you this evening to talk about the mess that we're in, which is indeed, I'm sure you figured it out, a very big mess. And it's a kind of cascade of crises. Lots of things are happening, lots of problems in the world. It's very hard to sort out exactly the different strands, and even when you sort them out, the finance, the macro, the environmental crises, the security crises. It's hard to know exactly how tightly these different threads are really tied together. It's going to take some more perspective than we have right now to figure this out, and it's probably one of those historical junctures that we'll never figure out. We'll just debate for a long time exactly what it means. But it's pretty big. It's more than a business cycle, more than a recession. It's a series of changes in the world that do have the feel of something, end of an era, beginning of something more, and we're trying to figure out what that is. Clearly, lots of different crises have come together at the same time. Partly, we have a financial crisis. That's certainly, I won't even say certainly, but it certainly seems to be at the essence of the short-run emergency now. The problems on Wall Street, City of London, and how they have spread throughout the world. We clearly have a massive governance challenge in the world where our institutions are not working very well, not those within the United States, and I would say also internationally, the capacity to really govern the global economy, to regulate global capital markets, or to solve many other kinds of global problems is really a major question mark right now. It looks a lot better to me after January 20th of this year than it did before January 20th, because we have a president who is very intelligent and committed to solving global problems, and we didn't have that before, as far as I could see. But still, the challenge of governance is huge. We also have a basic challenge of survival for a lot of the planet, and probably a challenge of survival that's getting worse. One can argue overall whether the spread of rich and poor has widened in the last 20 years, because there are many places where poor people actually got much better off, and China and parts of India are certainly two of those cases. But I think it's not arguable that the gap between the rich and the poorest people in the world has widened considerably, because there's a whole swath of humanity which is in desperate straits. And by desperate, if you don't come from one of those places, think about what you think about desperate economic straits and then divide by 10, roughly. It's worse than you think. And the crisis is more widespread and more deeply entrenched and tending to get worse than you think. And all of the nice things we say about nice things like economic growth and so forth don't really apply at the bottom right now, where life is hard, survival is in question, climate change, environmental degradation, population growth, now economic crisis are all making life even less bearable, less survivable than before. So all of these patterns are intertwined right now, and understanding how they, and I should say, by the way, one last point, which is not only the gap of rich and poor, but the stresses of the physical environment, energy scarcity, which clearly played a role in this immediate crisis when oil shot up to nearly $150 a barrel, the food crisis, which clearly played a role in the ensuing downturn when grain prices tripled last year in a few months. The fact of massive crises of water, food production, extreme weather events, and so forth is another phenomenon that's at a global crisis level that is also intersecting. I'm a little bit late because I'm coming from a pledging session of donors for Haiti just now, and Haiti, in a way, exemplifies some of this intertwined nature of crisis. Haiti's going through a crisis of collapsing remittances because Haitian expats in the United States have fewer jobs and are sending home less money than before, and it's already an impoverished country. Haiti already is a country where the underlying dynamics were getting worse, not better, by and large. And Haiti suffered 4 back-to-back hurricanes last year, an absolutely extraordinary swath of destruction that took down not only large numbers of lives and families, but also about 15% of gross national product in damage. And if you think about what that would mean in this country, that would be about $2 trillion of loss from a few storms. And it's even worse when you're poor as a proportion because you have no margin of survival. So the world, to me, feels really quite unstable and unsure right now. And I don't think we can really discern fully what's happening. We can't really disentangle these components, but to me it's a little bit like the slot machine coming up, lemon, 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 on each of the rolls. We have instability, we have profound unfairness in the world, and we have unsustainability. And we're hitting all 3 of them at the same time. And my guess is that we will not be able to find a solution to any one of the 3 unless we somehow tackle all of the 3. Now, I can say we've not been trying very hard. Maybe that's good news. This country, the United States, I think walked away from all 3 of these challenges over the last 25 years. And that's one of the big reasons why the world's in such a mess, because if the leading economy in the world and the leading power in the world stops thinking about being fair, becomes irresponsible from the point of view of stability of the economy, and stops worrying about environmental sustainability, the damage that comes from the failure of leadership at the core spreads to the whole world. And while I don't want to blame the world's problems on the United States, I think the U.S. definitely added to them in a very major way during the past generation, and mainly added to them through a bout of neglect and selfishness that has brought us to this point right now. Let me take each part of this puzzle just to describe a little bit of how I see the dynamics and how I see the linkages, and then pull it together perhaps in a little bit more convincing way as an interwoven story when I talk about what the solutions might be for the world as a whole. We're in the worst downturn in decades, clearly. Unemployment is rising worldwide. It's rising by millions and millions, by tens of millions, in fact. In the United States, every month, another 400,000 jobs or so are being lost right now. Unemployment was under 5% until recently. Now it's 8.6%. It will most likely soon be over 10%. So that's a very steep downturn. It's quite possible that it's the worst downturn since the Great Depression. That's what we hear every day. Now, it's nowhere close yet to the Great Depression, that's for sure. So, Great Depression had unemployment rates reaching between 25 and 35% of the labor force in most of the world. in the 1930s, and we're obviously still far from that. It's possible that it won't even be as bad as the deep downturn that we had in the early 1980s, which was a downturn related to Paul Volcker's policies at the Federal Reserve to squeeze out inflation in the economy by ratcheting up interest rates dramatically, put the economy into a deliberate downturn. He didn't want the downturn, but he did want the squeeze. And that led to soaring unemployment. And so far, we've not hit those levels, but it looks like we could. Unlike that crisis and another one like it in 1973 to 75, which were also worldwide, I'd say the depth of what's happening all over the world right now will beat the depth of what happened in those two serious recessions that the United States went through. We could have recorded, though I don't like these numbers given their inaccuracy and actually their lack of meaning in a certain sense, but it could be that the world output is measured as the gross world product by adding up national gross domestic products is negative in 2009 over 2008. That would be the first time since 1945, indeed the first time since the Great Depression. So that would be very, very serious. Where did this crisis come from? Well, we sense, and I think it's probably right, that the proximate cause is the financial markets. Probably the proximate cause is the financial markets just a couple miles from here, a few miles south of here on Wall Street, that this is a crisis that was really made in America's financial center. Exactly how that came about and why the ramifications are so big, I think, is a story that is not properly told and not yet properly understood. The usual story is rather simple, which is that, and partly true, which is that the financial markets were deregulated. A lot of, at the time, lucrative business was done, especially in subprime mortgages and more exotic and unregulated derivatives, especially the whole credit default swap market, which soared from nothing to tens of trillions of dollars of coverage in 3 years. Quite an extraordinary phenomenon. And that this is the essence of the bubble. I think there's truth to that, but I don't think it's really the full story. And I don't think it's the full story because it's that by itself, in my guess, it would not be big enough to explain a global, worldwide downturn of the sort that we're experiencing. It would probably be enough to explain a U.S. recession or a U.S. and U.K. recession, since what happened in Wall Street happened in the City of London quite closely because they're so interconnected. But I don't think it would have caused the kind of downturn that is being experienced around the world. So to my view, we need to add one more major dimension to this, and that's monetary policy. That what we're seeing is a crisis that combines monetary policy failures with regulatory failures, and that it does this in a way which goes back not 2 or 3 or 5 years and is not focused on the subprime market or even the credit default swap market, but is part and parcel of a whole way of governing the financial and monetary system in this country over a 20-year period. What I see is a hyperactive and overly expansionary Federal Reserve Board under Alan Greenspan, combined with ideologically not just lax, but determinedly unregulated and deregulated financial markets. And that seems to me to be the lethal combination. U.S. monetary expansion way overdone on several occasions, making lending extraordinarily easy and borrowing extraordinarily easy. And because of the central role of U.S. money markets, that dramatic money expansion quickly spread to all the rest of the world. so that what we experienced here was actually experienced in other parts of the world also, even without their Wall Streets. Not in the exotic instruments, but in the very frothy borrowing, building of real estate, bidding up of asset market prices, which then collapsed. So if you look at Greenspan's behavior as central bank chair, Fed chair, from 1987 until 2006, a very long stretch, just long enough to wreck the world economy. What you see is that every time the U.S. economy started to ease, the Fed became tremendously expansionary. And he took it as the task of the Federal Reserve System to avoid all downturns. It's interesting that that happened just as economic theory was teaching that there should be some reticence in the extent of fine-tuning of monetary policy. The way Greenspan behaved is actually the way Keynesian economists were trained to react in the 1950s and 60s. But then came a period of doubt about the efficacy of these tools in the 1970s and 80s, led in fact by the so-called rational expectations revolution in economics, which said, be careful. You can't really stop all downturns. Don't go so aggressive in monetary or fiscal policy to stop a slowdown in the economy. Seems to me that Greenspan took a very different view, which was that if the economy looks weak, cut interest rates very sharply, try to stabilize the economy. If it looks even weaker, go further. And even if this is a risky policy, it's less risky than the alternative of a recession. And it worked for a long time. But it has, I believe, the character of what we also once called in economics instrument instability. The idea that if you're turning the dial to try to stabilize an unstable system, you have to turn the dial ever more wildly because you don't really have control of the underlying system. So Greenspan turned the dials to expansion in the mid-1990s when the economy was easing and helped provoke the East Asian financial crisis, which was a crisis in which hot money from the money centers of New York and London quickly flew to the Southeast Asian and Northeast Asian financial markets, bid up real estate, and then were subject to a rapid withdrawal of lending in 1997, actually starting because of a devaluation of one of the currencies, the Thai baht. So that was a hot money crisis, which actually brought a deep crisis to Asia, not unlike the worldwide crisis now. As soon as that happened, the U.S. economy started to slow down, as you can imagine. So Greenspan cut interest rates sharply and set off a second bubble, and that was the dot-com bubble. If you look at NASDAQ and the Dow, it soared, of course, between 1998 and 2000 to dizzying heights. And that was the time when anybody that had a .com in the name could become a billionaire in a day. You didn't even have to have a desk or an office. And we bid up astounding paper wealth, which all came tumbling down in a very short period of time. It was also the period when the final twists were put on deregulation, which Greenspan, Summers, and Robert Rubin championed in 1998 and 1999. No regulation of the derivatives, no regulation of break down or end the Glass-Steagall separation of Wall Street and commercial banks. And so this was a frothy period of a tremendous U.S.-based financial bubble combined with deregulation. Turned out it was a warm-up operation, because when the market collapsed in 2000, 2001, Greenspan cut interest rates even more sharply. When 9/11 occurred, they went down to 1%. and they were held at this historically low level until 2004, and then slowly were allowed to creep up. That third one is the one that produced this massive outcome that we're now living in. You had, by then, a deregulated financial system and a massive expansion of credit all over the world. The stock market soared again. But this time also the housing market soared, because one of the inventions was, of course, the asset-backed securities, the mortgage-backed securities, and the credit default swaps to insure the mortgage-backed securities. So the perfect system was in place. 1% interest rates and the no-loss investment proposition. And Wall Street, of course, loved it because it booked phenomenal profits and took phenomenal pay, the likes of which were simply unimaginable even years before. These were the years of $30 billion plus bonuses on Wall Street. Now, anyone looking at that, in my opinion, should have been horrified and frightened. Horrified at the social implications, but we cheered it on in this country. And deeply frightened that something cannot be right with this picture. But we took it as kind of normal, and I don't know, 50, 60, 70, 80% of the business school graduates each year headed straight for the financial markets, and why not? And this was extraordinarily frothy for 3 or 4 years. Banks all over the world were able to tap into it. What's remarkable is how big the paper wealth increase was in a short period of time. Something which history shows again and again is really a dubious proposition. If you see wealth on paper increasing by, my guess, $40 trillion between 2002 and 2006, probably one shouldn't just stand up and cheer, but one should say, what the heck is going on? And of course, there were a few economists following this closely, like Bob Shiller or Nouriel Roubini, George Soros as an investor, who were saying, indeed, this is absolutely manic and out of control. And you know the story as well as I do from 2006 onward, as interest rates started to rise and as the no-payment mortgages started to require some payments, foreclosure rates started to increase. That led to a cutback of new lending on mortgages because they had become so subprime that the sustaining of trillions of dollars of new mortgages was not possible. There just weren't new candidates to hand out houses to. There was a cutback of lending. The rising housing values peaked in 2006. Those were the collateral that was supposedly standing behind all the mortgages. When they peaked and started to come down, a lot of mortgages then went underwater. Households owing more than now the decreasing value of their homes. That led to further cutbacks of new lending, as well as to financial embarrassment of structured investment vehicles, starting with Bear Stearns and some others, which started to close down in 2006 and early 2007. That led to another cutback of this kind of subprime lending. That accelerated the drop of housing prices. And that's just the mechanics of how a bubble bursts, because the bubble is predicated one way or another, either expectationally or in terms of collateral, on rising underlying values, which when they stop, spiral down into decline. So what went up, maybe 30 or 40 trillion dollars, came down by, I would guess, about $40 trillion by now between 2000 and 2006 and now. Stock market valuations added worldwide is a loss of about $30 trillion. Now remember, the world economy is roughly 50 to 55 trillion per year of production. So we're talking about, in stock market losses, 50% of annual production. That's a phenomenal decline, of course. Add in house price declines, and that is probably, I've not seen anybody make the calculation, but perhaps another $10 trillion of paper loss so far, perhaps another $5 to $10 trillion more to come. So we're talking about a loss of wealth that's 40, 45, even $50 trillion. That's actually real money. I mean, that's a lot of wealth decline. And so we've had this calamitous decline of wealth since households had borrowed against the wealth, since the construction industry had built against the lending. What we're seeing is a massive cutback of consumption worldwide as household wealth is now understood to be profoundly less than it was judged to be 2 or 3 years ago. And it's that collapse of consumption which is the leading edge of this deep downturn that we're in. There's a second major component of the downturn, and in fact it's one of the interesting questions of macroeconomics, much debated and I think probably wrongly presumed in our public discussion in terms of relative weight. But the second channel of downturn is that bank capital has been profoundly impaired because banks lent mortgage loans, which went bad. They lent other kinds of loans. They held other kinds of asset-backed securities. And as those have gone into default or become illiquid or lost market value, that has wiped out trillions of dollars of bank wealth. The claim is that that loss, now that did two things, of course. One thing was that it contributed to an undoubted financial panic starting last fall. Well, it actually started even in the summer of 2007 when spreads on interbank loans widened quite considerably. But it became dramatic after September 15th when Lehman Brothers went into default and went into Chapter 11, and then there was a full-fledged financial panic. And a financial panic basically means that there's a profound deleveraging that takes place all of a sudden so that short-term credits cannot be obtained or rolled over. And it's rational because if all short-term creditors are withdrawing their claims, the chances that the debtor becomes illiquid and then defaults on loans rises. And so any lender, whether they believe in the underlying weakness of the borrower or not, is rational to withdraw loans along with all of the other short-term creditors. And so we had a massive deleveraging take place right after Lehman Brothers went into default on September 15. Remember, that was the weekend of Lehman, Merrill Lynch, and AIG. That is a weekend that will go down in financial history as one of the most dramatic of modern times. In addition to that, the banks lost capital. So Lehman lost all its capital, and some others lost all their capital, but the commercial banks generally didn't get wiped out by this, but had their capital deeply impaired. And both from a behavioral and a regulatory point of view, they have to cut back their loans sharply as their capital base shrinks. And so the argument, and that was the point I was wanting to make, that why are we in this massive downturn now? There are three arguable reasons. One is a loss of wealth that's massive. A second is financial panic that's intense. And a third is impaired bank capital, which means that the channels of lending are constricted. And probably they all play some role. But the feeling right now in the Obama White House, for example, is that the bank lending part is the key to turning on the economy again. If the bank capital can somehow be restored, then normal lending will resume and we'll be back to some kind of healthy economy. Whereas my feeling is that the first of these three elements, the loss of wealth, is even more important than the constriction of bank capital. So we could easily find that we throw trillions of dollars towards the banks in the TALF and in the TARP and in the PPIP and in all of these other ways that that they are proposing to bail out the banks. And after that's done, we still have an economy that perhaps isn't in utter collapse, but isn't exactly dynamic and healthy either, because households simply don't want to spend as much as they used to because they're broke or their wealth has been shot through roughly $20 trillion of loss in the U.S., maybe 15 trillion so far, going up to 20 trillion of loss in the U.S. alone. And that, to me, my mind, is a more likely scenario. So I think that all these heroics that are taking place towards the banks are unlikely to restore great dynamism to the U.S. economy. But they will do something that brings me to the second of the three problems that I wanted to talk about, and I won't talk about them as much. They will add to the profound unfairness of our society. So I believe that a lot of this happened because we had a period of utter irresponsibility of the political and economic elites in this country, who were so happy to be making gazillions of dollars that they lost sight of prudence, fairness, decency in how our economy is run. And I think Wall Street leadership was miserable and perhaps worse, and the kind of behavior that Wall Street leaders have continued to show, like Merrill Lynch taking $4 billion of bonuses in December, to my mind, it's so incredibly scandalous, shocking, perhaps illegal, but it's stealing my money, I feel, that it exemplifies a situation in our country that is really out of control. The fact that it barely got a little bit of notice, but not much, and it has now passed the scene, $4 billion before your eyes of a bonus of a bankrupt company using taxpayer money, barely a notice, to my mind, is a real indictment of our society right now. Now, maybe people are confused in the public and they are annoyed, but where is the political leadership, the president, the Congress? Where's the oversight? Where's the criminal justice system? Where is the sense of decency among the financial leadership to have this happen in full view? So the second problem, I think, is related to the first. We went for 30 years in this country with increasingly Wall Street running the government rather than the government regulating Wall Street. And Wall Street, till today, sends its people to figure out how to bail out Wall Street. And the conflicts of interest are so profound, in my opinion, as to be manifest, manifold, amazing. And, of course, I think lots of people are unhappy, but it doesn't stop things because that's the way the system works. And Congress barely regulates anything because the congressmen, I suppose, are also campaign contribution recipients from the same companies, or they don't feel that it's within their ambit to monitor this. So we had not just the deregulation in the last couple of years, not just the subprimes, but we had a whole series of financial market deregulation over 25 years that have has just done tremendous damage to our society. We had the savings and loan crisis, which was absolute scam and criminality, and cost, at the time, a couple $100 billion to the taxpayers. But that was just an example of what was later to come, because it was followed, that was a deregulation scandal, followed by all of the deregulation of the investment banks, the ability of these banks to form the shadow banking sector, which was the structured investment vehicles that financed and promoted all of these lousy assets. And basic finance theory and basic regulatory history would have taught us that you don't allow a multi-trillion-dollar shadow banking system to develop without financial regulation, without capital asset restrictions, not at 30 to 1 as it was for many of these SIVs, without a lender of last resort, and so forth. So how did it happen? Was it just people believing in the efficient markets hypothesis? Or was it something really unbalanced about American society? And I believe it was the latter, because one could watch just how much money was being made, how fast, without a care or a sense of responsibility, and with the leadership for these decisions vested literally in the people that were running these firms, although they were taking a year or two off perhaps to be in Washington rather than back in these enterprises. And this, to my mind, is a symptom of something pretty rotten in how our body politic works. Now, we know one of the outcomes of this is that the amount of wealth and income inequality in this country reached levels that we've never seen in history. That the top 0.1% of wealth owners, I don't know the numbers offhand, I couldn't check them to quote to you, but the share of wealth that's owned is a large multiple of the amount of wealth owned by the poorest tens of millions of people in this country. And this happened dramatically and in front of our eyes. Now, had our society been worrying about this at the same time, what's happening to all the poor people in our country, what should we be doing about it, the people that don't have unemployment compensation, the people that can't find work, the people that don't have health insurance, it would be then perhaps you'd say, well, market forces are creating these large increases of wealth, but at least the society is compensating. But how did we compensate in this country for this widening income and wealth inequality? We compensated by multiple tax cuts at the top. We compensated by eliminating the welfare system in the 1990s, because after all, the poor were wasting our money. That was the charge. We compensated by seeing Congress vote down many times coverage for even the most basic health care for the poorest children in this country, something that only began to be reversed just last month or 2 months ago after President Obama came into office. So as wealth soared, we really added insult to injury, and injury to insult, more accurately, by taking away the basic social protections for the poorest people in this country. And we systematically neglected the poor in the rest of the world. That's partly my business. I spend a lot of time trying to raise funds for people who are dying otherwise, because they don't have enough to eat, because they don't have basic inputs to produce, because their children can't get $1 medicine to stay alive, because they have no cash income and can't afford a bed net. You know how hard it's been to get American society to respond at all to this? Virtually impossible. aside from symbolic interventions, and one semi-properly funded program for HIV/AIDS, and now maybe a second one for malaria. But in general, this country found in its power the ability to have aid fall to a level, well, I should say the rich countries combined gave less aid, net of some debt relief calculations, than Wall Street bonuses, Christmas bonuses each year. Less aid to Africa, I should say, for 800 million people. And when Merrill Lynch stole $4 billion last December, that was about the size of the U.S. aid program to Africa. So we really undercut the support for the world's poorest people, barely paid it a due. We have one of Goldman Sachs' former bond traders writing a book about how terrible aid is and the poorest people in the world should just float bonds. It would be a joke if it weren't for real. But that's really a jaded society, I have to say. And that's what we came to. So this is our second problem here, which is that it's not an accident that the financial markets became deregulated. It's not an accident that monetary policy was devoted to keeping the stock market rising. It was part of a larger social process, and a social process in which let the markets speak and do all, don't care about income distribution, don't talk about the responsibilities of the state, and that's true all the way down the income distribution to people who literally cannot feed themselves to stay alive. Even for them, we can't really find the will to do much of anything. So that's the second problem. That's a big one. And it's really a big one if you happen to be very poor. And my standard of life is just always asking myself, if my daughter were in one of the villages where I'm working, how would I feel about public policy, the choices we're making? If my daughter were a villager, had to sleep even one night without a bed net in a holoendemic malaria zone, it would drive me absolutely nuts. And yet we leave 1 billion people like this, where it's absolutely predictable what we're doing, and the 9 million deaths of young children that result from our casual disregard is also absolutely predictable year to year. Now, the third thing we neglected, because we were so happy making so much money so fast, is all of the profound evidence of how we're increasingly deranging the Earth's ecosystems. And I won't go into any length on this except to say that it's, as director of the Earth Institute, every day I hear or see, read, or have described to me new scientific evidence that it's a lot worse than we think, and that the pace of underlying ecological destruction is greater than we knew. The risks of that ecological change on our food systems, our water supplies, our biodiversity, the functioning of our ecosystems generally is worse than we've imagined. So how did we go for 30 years not doing anything about it? That's also a social puzzle. Because, after all, this problem of climate change has been elucidated since the 1980s. In 1992, we actually signed a global treaty, the UN Framework Convention on Climate Change, to do something about it. We actually signed 3 treaties in Rio in 1992, one on climate change, one on biodiversity, which the United States never ratified. Why would we ratify something about preserving species on the planet? And other species. And the third one on combating desertification, which is the area in the world that is most unstable and most dangerous, the parts of the world where we have American troops dying and killing people every day from the Horn of Africa into the Middle East and into Central Asia. So we've realized already for almost 20 years by treaty how serious this is, but we didn't do anything about any of them during that period. So that's another sign, I think, of a society that has really somehow missed the point. And again, societies, that's a hard indictment. I'm mainly talking about our political and our economic elites who have a responsibility to know about these things and help to lead change. Now, in the case of climate change, probably it really was the oil industry which played the leading role in making sure that nothing happened. ExxonMobil, number one, as funding for a long time, quite serious amount of public disinformation. And many other companies as well playing this role. And probably it's something like what we have in finance as well, that our politics became so completely enwrapped in the interests of very powerful industries that we lost the ability to separate public policy from sector interests. And probably the powerful role of these industries in electing presidents, oil in electing the Bush administrations, and Wall Street in electing all of the administrations, both Democrat and Republican, is at the core, I would guess, of this kind of derangement. The broad public can't really know unless the leadership is helping to explain, because these are complicated topics. The amount of our public discussion is very limited. What the president talks about sets the pace for what we hear about. And if we went 20 years where this is hardly discussed, the results are likely to be as they are right now. So to my mind, all three of these crises are bursting in front of us right now. A financial, monetary system that is unstable, a national and international society that is hugely unfair, and a mode of economic production, a set of technologies that are unsustainable environmentally. And all of them, in my opinion, have solutions. And I've tried over the years to say not only do they have solutions, but the solutions from the point of view of society's broad costs are much, much less than the costs of avoiding action. And we're seeing that right now. But we haven't been able to get organized to find our way out. That brings me finally to the G20 meetings a couple of weeks ago. We designated the G20 as our new macroeconomic organization or set of countries for cooperation. It's an interesting choice. It's much better than the G8, which represented 1 billion high-income people. The G20 represents about 4 billion people out of the 7 billion on the planet. And so that's a big improvement. It's basically the high-income and the middle-income world. It still doesn't even include the poor in the world, except through India's representation. But Africa, poor Africa, is not at the G20. South Africa, which is a very different condition from the rest of sub-Saharan Africa, is in the G20. So there's some improvement. It's a bit more representative. Still, if you happen to be at the bottom of the pile and trying to stay alive, the G20 was not exactly the most likely place to come to your rescue. So what did the G20 do? It was kind of interesting. It was quite interesting, actually, to watch. And it's kind of interesting, the first steps that they took. Basically, they focused on the short-term liquidity side of this story. And they said that the most important thing was to preserve access to loans. And that may be true for middle-income countries like those of Central Europe, which have seen bank lines of credit withdrawn in this deleveraging process. And the proposal of the G20 is that the International Monetary Fund will now lend tens of billions of dollars to the governments of the middle-income countries to replace the bank loans that have been withdrawn. It's not a bad step, and it may be appropriate for those middle-income countries. They also talked about, though whether anything more than on paper will ever emerge is very unclear to me, a broader amount of international regulation. The U.S. fought hard against truly international financial market regulation, but it agreed to a coordination of regulation. And on paper, there was discussion about more regulation of hedge funds, derivatives, executive compensation, and tax havens. Those were the areas that were identified. Whether it adds up to anything is a guess, because it's easy to put that on paper. It's not so easy to actually do anything about it against the interests of political interests here. And I found it curious and interesting that the day that the G20 called for more financial transparency, the FASB here, which is the regulatory body for accountancy rules, issued its ruling that banks no longer had to mark loans to market. And so they went exactly the opposite way of what the G20 was announcing, to preserve the fig leaf for our banks, to give more time for the bailouts to save the shareholders and the bondholders. Almost the opposite of what was being discussed in London. The G20 did almost nothing for the poor. There's a paragraph that says we should help the poor. That was nice. That was taken to be a big victory. And there's a paragraph that said we should reach an agreement on doing something about climate change in Copenhagen at the end of this year, when a 2-year negotiating process is supposed to come to a close. Well, it's very unlikely that at Copenhagen we'll actually reach any kind of comprehensive agreement. Maybe we'll reach some kind of agreement, but there does seem, at least among a lot of the negotiators, to be a backpedaling of what could actually be achieved in that process. Where are we, therefore, from my point of view? We are in a crisis that probably will not turn into a Great Depression, because we have enough policy instruments and enough levers to prevent that from happening. And we have enough historical experience not to let banks crumble. We have deposit insurance, we have lender of last resort facilities, and so forth. And the fact that we're putting money into doing something about this, I think, is good and very important. But we'll continue to have a worsening downturn in terms of employment, at least through 2009, and we'll have high unemployment in this country and in many other countries for many, many years to come. But for me, the bigger question, even than that, as painful as that is whether we're going to get to root causes, or whether the goal is to try to make things right by somehow bailing out the banks, getting the lending up, getting people buying houses, and going on as if it was all a bad episode and a bad dream, and now we can go on to be the America that we were before 2008. That clearly is the intention of a lot of people, and it's the intention of a lot of policymakers. I don't think it's the intention of President Obama, but I do think that it's the intention of a lot of the policymakers around, and the hopes, certainly, of Wall Street and others, that we can just somehow dig ourselves out from this, and that nothing was too fundamentally wrong, and nothing really needs to change. If we go that route, I think we will find ourselves in a worsening and worsening global situation, because these phenomena of deeper instability, lack of proper care for our society, the gaps of rich and poor, and the way that we are recklessly interfering in environmental systems now are real. And they're deep, and if they're not addressed, they're going to come back to bite us even worse than this trial run that we're living in right now. So the interesting thing for me right now is not how fast the recovery is, but how deep the reform is. Because a fast recovery without the structural and the ethical changes that are needed for a sustainable society and a sustainable economy will not get us to where we need to go. So thanks very much.